Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 14th of April. We all know, of course, just how turbulent markets have been. It depends which day of the week. This week you happen to have a glance at the markets. If you looked on Wednesday, you'd have seen some very, very sharp rallies. But that masks the fact that tariff trauma is very much still in play. Only Friday morning we've had another retaliatory measure from the Chinese. They've now upped their tariffs on the States to 125%. in answer to the States' tariffs on China of 145%. And of course, when the two world's biggest economies are basically at loggerheads, this is the kind of fallout that we've had in the markets, not only in terms of the fact that US Treasury bonds are seeing their yield spike, but also, of course, a rush to haven assets. That's quite apart from the fact that we're just about to go into the first quarter reporting season, where the outlook comments for the few months ahead are likely to overshadow the results themselves. So, in the year to date, the Dow Jones is currently down by 6.9%, S&P 500 by 10.4%, Nasdaq by 15.1%, FTSE 100 holding up slightly better, down about 2.9%. Turning to next week on the UK front, there's three companies worth keeping an eye out for. First of all, we've got full year numbers from Sainsbury, shares down around 14% over the last year. Obviously, the cat's been put amongst the pigeons here when Asda announced that it would be entering what could well turn out to be a trade war. That's weighed on the likes even of Tesco, but of course it's likely to weigh heavier on Sainsbury's. If you look at general market shares at the moment, Asda's market share is about 12.5%, Sainsbury's about 15%, so they're fairly close rivals. A few other things to look at, as you would do for a supermarket's full year numbers, any discounts they've been investing in, how it's affected their margins, whether its focus on Nectar is actually coming to fruition. They previously said that they saw incremental profit of £100 million coming along in the next 3 years, and also, of course, its Argos arm, which has been suffering. There is also a half-year update from WH Smith. Shares down 29% over the last year. Recently announced that it will be selling off its high street business. Probably an obvious strategic move. Its travel business, on which it will now be concentrated, did account for around 85% of profits. And of course, this is the part of the business which tends to have captive customers, if you like, because we're talking about hospitals, airports, railway stations, etc. And alongside that, they've got these in-motion stores which are looking after the tech side of the equation, and they're also trying to expand in the States. Finally, Barratt Redrow has a trading statement, down 11% or so over the last year. The combination or merger of Barratt Developments and Redrow is already showing some signs of success. They tend to be fairly complementary. Redrow is at the more affluent end of the market, so you can see the obvious complementary and synergistic ties there. They're looking for something like £100 million per annum of cost savings, but as ever with house builders, have a look out for the current rates of reservations and indeed their forward order book. Thank you for watching. Have a great week.